My personal dividend growth portfolio is cruising along with a compounded annual growth rate of 25.26%. When I started this portfolio, and really this dividend growth strategy, my goal was to hit a 12% CAGR over the long term. Nearly 2 years in, the portfolio is significantly exceeding my expectations, and I didn't even get to the best part yet. This is a passive portfolio that does not require a lot of effort on my part. I don't have to decide which stocks to buy or when to buy them. All I do is use a simple set of rules to find the potentially best stocks once per year. I allocate my money equally amongst all of these stocks, and I sit back and relax until next year. I call this dividend growth strategy the 4-factor strategy because it's based on 4 financial factors that help me identify the best dividend stocks at any given moment. Let me tell you about my actual portfolio and talk about the results it has achieved. Then I'll explain exactly how this strategy works, and I'll share with you the best dividend stocks it identified right now. My portfolio is made up of 25 stocks that this strategy identified on October 31st, 2023. I invested an equal amount of money, so 4% of the capital allocated to this strategy into each stock on November 1st, and I'm going to hold these positions until October 31st of this year. Then I will repeat the same process and hold the newly selected stocks for 12 months as well. Let me quickly run through all 25 holdings and tell you what return each stock has generated between November 1st of last year through the end of September. First up is ADP, that is up 29%. Next we have ASML Holdings, that is up 40%. Then we have Broadcom, that is up 108%. Cohen & Steers is up 90%. EOG Resources is just shy of a 1% return. Fastnell is up 25%. Home Depot is up 46%. Infosys is up 41%. Lowe's is up 44%. Lam Research is up 40%. Landstar is up 16%. MasterCard is up 31%. Masco is up 63%. Microchip Technology is up 15%. Monolithic Power Systems is up 110%. Old Dominion is up 6%. Paychex is up 24%. Robert Half is down 7%. Rollins is up 36%. SQM is down 11%. Skyworks Solutions is up 17%. Texas Instruments is up 48%. UPS is up 1%. Williams Sonoma is up 108%. And Watsco is up 43%. If you average out all the returns, the portfolio is up just shy of 39% over the last 11 months. As you can tell, some of these picks are doing fantastic, some are average, and a few are not so great. Like any rules-based strategy, not all of the chosen stocks are going to go on to be winners. But if this process can pick more winners than losers, then on average, it can lead to pretty great results. The portfolio I am talking about today is rather small in terms of market value. It's about $2,600. When I set this strategy into motion, I repurposed an old traditional IRA account that had a little more than $1,800 to test this strategy. I have since dedicated more of my money to this strategy, about $300,000 in total across 2 other accounts. But since this small portfolio was the first one to track this strategy, it has the longest history for me to measure. I also haven't added any capital to this account since launching this strategy, so it makes tracking the results very simple and straightforward. I am still contributing money to the 2 other accounts, and those cash flows distort the performance and dividend growth. So let's talk about the performance for a moment. In its first year, this strategy was a little different. It was made up of 30 stocks, and it had a stupid weighing system that ended up adding no value to the total return. If you're interested in finding out more about the first year, you can look at some of my old content. I've been documenting this strategy since inception. The final return for year number 1 was 10.9%, which was slightly below my 12% long-term target. To give you a little more context, the period from November 1st, 2022 through October 31st, 2023 wasn't that great for the stock market. The S&P 500 had a return of 10.14%, and schd had a return of minus 4.51%. So even though my portfolio didn't meet my goal of a 12% return, it kept up with the S&P 500, actually slightly outperforming the index, and it grossly outperformed schd that had an awful 12-month period. Year number 2 is thus far significantly better. My portfolio has a return of 38.85% heading into its last month. However, the overall stock market has been rather hot during this time period. The S&P 500 is up 39.28%, and SCHD is up 29.42%. So my portfolio is narrowly trailing the S&P and cruising along a little more than 9% ahead of SCHD. Putting it all together, the portfolio is up 53.99% since inception, compared to a return of 53.41% for the S&P 500 and 23.58% for SCHD. Beating the S&P 500 isn't really the objective here, although it's nice to see this portfolio keep up pace with the broad market. Beating SCHD also isn't the objective. The goal is to hit a long-term CAGR of 12%, and by long-term, I am talking about at least a 5-year time period. So far, almost 2 years in, the CAGR stands at 25.26%, which gives this portfolio quite a large cushion should it hit a sour period anytime in the next 3 years. Since this is a dividend growth strategy, let's talk about the dividend income and growth. Over the past 23 months, the portfolio generated $93.42 in dividend income. That's $41.29 in year number 1, and $52.13 thus far in year number 2. Remember, we still have 1 month to go before year 2 will be finished, so a few more dollars should trickle in. Based on the current dividend income, the year-over-year dividend growth is a little more than 26%, which is pretty phenomenal. Once the October dividends are paid out, this dividend growth rate could climb closer to 30%. Something to consider here is that the dividend income in year 1 was below initial projections, likely due to the portfolio missing a few ex-dividend dates at inception. The projected annual dividend income, or PADI, at portfolio launch was $46.79. Today, the PADI stands at $56.19, which is a 20.09% increase. If we annualize this increase over 23 months, it equates to a 10.02% annual dividend growth rate. I prefer to compute the dividend growth based on real dividends paid out, but I know some people really like to measure their dividend growth looking at the PADI. Comparing year number 3 to year number 2 should be a little more accurate, so we will see if the 20% plus dividend growth trend can continue. I know investing in funds like SCHD will generate more dividend income right now, and that can be appealing to many dividend investors. My focus is geared towards total returns, but I also like to see my dividend income grow. I expect that at some point, this portfolio will generate more dividend income than SCHD. This is something that can actually be tracked to see exactly when this break-even point will occur. I am tracking how an equivalent investment into SCHD would perform and how much dividend income it would have generated. I am tracking this on a quarterly basis, a rolling 12-month basis, and by fiscal year. On a quarterly basis, my portfolio started out nearly 70% behind SCHD. Granted, my portfolio only had 2 months of dividends in the first quarter I tracked, and missed some dividends in that first month due to the timing of my investment. During the following 3 quarters, my portfolio trailed SCHD in total dividends by about 30%. Then in quarter 4 of 2023, my portfolio reached its lowest margin to SCHD, delivering 12.7% less dividend income. This was partly a fluke as the timing of the rebalance for the second year produced more dividend income than initially expected. By quarter 1 of 2024, the difference in dividend income widened again to about 20%. And more recently, in quarters 2 and 3 of this year, SCHD raised its dividend rate by a solid amount and widened this gap back to about 30%. On a rolling 12-month basis, my portfolio has been trailing SCHD in the mid-20% range for the last 4 quarters. On a fiscal basis, my portfolio came up 36% short of SCHD in year 1, and thus far in year 2 it is about 30% short. But remember, my portfolio still has October dividend income that will be added to year 2, so the margin of difference to SCHD should be less than 30%. It'll be interesting to see how this progresses, and how long it'll take for my portfolio to catch up to SCHD. My portfolio pays a dividend yield around 2%, while SCHD's yield is closer to 3.5%. However, my portfolio is achieving a better total return and seeing faster dividend growth. If both these things can continue going forward, my portfolio should see the dividend income gap shrink over time. There will be a few minor changes for year number 3. The first change will be a reduction in the number of holdings from the current 25 down to just 20. I've been tracking how a 20 holding portfolio would have performed, and both in year number 1 and year number 2, it would have led to a higher total return. In year number 2, the more concentrated 20 holding portfolio is running about 3% higher than my actual portfolio. The second change for year number 3 will be no more monthly rebalancing. In the first year, and in this year, I've been rebalancing this portfolio at the start of each month, bringing the weight of each stock back to the original 4%. But I've also been tracking how a non-rebalanced portfolio would have performed, and it would have generated a little more than 0.5% in extra return. Not having to rebalance this portfolio every month will make this strategy more passive, and if it leads to a better return, it makes sense to implement this change as well. Alright, let's talk about how this strategy actually works. Like I mentioned at the beginning, this strategy revolves around 4 financial factors that, in my opinion, help me narrow down a short list of the best dividend stocks to invest in at any given moment. When you think about what success in investing looks like, actually it's quite simple. All you need to do is identify great businesses and then figure out if they are attractively valued. Then you simply invest in these companies at the right time and patiently wait to be rewarded with above average returns. If you can figure out these 2 things with a high level of accuracy, it will lead to great results. Both these things sound fairly simple, but in reality they are anything but simple. What does a great business look like, and how do I know if it's attractively valued? These are not easy questions to answer, and it's even tougher to make such predictions about a given company with a high degree of confidence. To approach this problem from a different angle, I decided to invert. Instead of going one by one and figuring out if a given business is a great business and if it's attractively valued, what if I could use a set of rules to help me find a short list of stocks that are highly likely to be great businesses and potentially reasonably valued? I call this process the 4-factor strategy, and it's made up of 2 parts. Part 1 is identifying potentially high-quality businesses. Part 2 is figuring out which of these businesses look more opportune today relative to the rest. Let's break down part 1 first. How do we find potentially high-quality businesses? Well, for me, the process is as follows. I use a stock screener with the following 8 conditions. The stock must trade on the New York Stock Exchange or the Nasdaq, because I want to be able to easily invest in the stocks I find. The stock must have a wide or narrow moat rating from Morningstar, because I prefer to invest in companies with economic moats. The stock must have an exemplary or standard stewardship rating from Morningstar, because I'd rather invest in businesses that are run by competent people. The stock must have a 5-year revenue growth rate of at least 5%, because I want to invest in a company that is growing. The stock must have an earnings per share growth rate of at least 5%, because I want to invest in companies that convert top-line growth into bottom-line earnings. Since this is a dividend-focused strategy, I also screen for a 3 and 5-year dividend growth rate of at least 5%, because I want to invest in companies that are committed to growing dividends. And the final condition is a payout ratio no greater than 80%, because I want to invest in companies that have room to keep increasing their dividends. Typically, this screening process gives me a short list of about 100 potentially high-quality dividend stocks. I don't necessarily want to invest in that many individual companies. So part 2 is figuring out which of these companies look more attractive today relative to the rest. This is where the 4 factors come in. I rank all of the stocks that pass the initial screening process across the following 4 metrics, with the objective being to identify companies that are the best across the board. The 4 factors are the free cash flow to total debt ratio, because I prefer companies that are very liquid. The return on capital, because I prefer companies that are highly profitable. The 5-year dividend growth rate, because I prefer companies that grow their dividends at an above average pace. And the forward dividend yield, because I prefer to invest in companies that have higher dividend yields. The objective is to rank companies that pass the screening process across all 4 factors and invest in the top-ranked stocks. I started my 4-factor journey on November 1st, 2022, and thus far it has worked out well. But since June of 2023, I've been running this process every month and tracking the results of each 4-factor list. I want to gather as much data as I can on this strategy to make it better and also to share it with others. I am not recommending that anyone invest in this strategy. I share it more so to give you an idea of a potential strategy to follow, or so that you can build a similar strategy that is custom tailored to your investment philosophy. As of today, I have 17 monthly 4-factor lists, of which 5 have completed a full 12-month cycle. The average return for the 5 lists that have completed a full 12-month cycle is 27.07%, which is pretty strong. Granted, the average return for SPY, the S&P 500 ETF, for the same time periods is 27.18%. So the 4-factor strategies, on average, are trailing the S&P by a little bit. Relative to schd, these 5 lists have outperformed by about 10%. The ongoing lists all have mixed results. Some are beating SPY and schd, and some are not. But I'm waiting until each list completes a full 12 months before I pass judgment on the performance results. What I want to find out is if my portfolio returns are a fluke, or if there is merit to this strategy. I shared the October 2024 list just a few days ago, and thus far it has gotten off to a great start. The top 20 stocks for October are up 2.49%, while SPY is down 0.14%, and schd is up 0.14%. Granted, we are only 4 trading days into October, and this list still needs to perform for the remainder of the month and the next 11 months. So let me tell you which 20 companies rank the best, and which ones are off to a good start in October. Number 1 is EOG Resources, that is up over 8%. Number 2 is Infosys, that is up over 2%. Number 3 is Dividend Energy, that is up over 8%. Number 4 is ConocoPhillips, that is up nearly 9%. Number 5 is Ambev, that is up 1%. Number 6 is Novo Nordisk, that is down 3%. Number 7 is ADP, that is up 3%. Number 8 is Paychex, that is also up 3%. Number 9 is Diamondback Energy, that is up nearly 13%. Number 10 is Old Dominion, that is down 3%. Number 11 is Accenture, that is up 2%. Number 12 is ASML Holdings, that is flat. Number 13 is Rollins, that is down 1.5%. Number 14 is Dick's Sporting Goods, that is up 3%. Number 15 is Hershey, that is flat. Number 16 is Visa, that is up 1%. Number 17 is Lam Research, that is flat. Number 18 is Monolithic Power Systems, that is up 1%. Number 19 is MasterCard, that is up just shy of 1%. And number 20 is MSCI, that is up just over 1%. Collectively, these 20 stocks at the start of October had an average forward dividend yield of 2.36%. They had a 5-year dividend growth rate of 21.25%, a return on capital of 23.35%, and a free cash flow to total debt ratio of 518.21%. I share the 4-factor strategy with my Patreon community at the end of each month, and I also give my patrons access to this Google spreadsheet that tracks all of the returns and shows the full list of all stocks that passed the initial screener for each month since June of 2023. If you'd like to check it out, there is a link to my Patreon in the description below. I hope you enjoyed the content. Have a wonderful rest of your day.